everybody, it's me, the Einstein and Wall Street from the balcony at the New York Stock Exchange. This is a little bit cosmic for me. I'm feeling like all the planets have to align, and a couple of alien abductions and whatnot. We got Dan coming from wherever Dan is. We got Tim coming from right next to me here, and I'm here. We are in the balcony, and look, it is December 4th. We are 4 days into this month. We, as I've said to you, both of you guys, over and over, every possible thing that could be thrown at a market has been thrown at this market, not only this year, and we've survived it, whether it's a couple of global wars, whether it's tariffs, whether it's interest rate stories, whether it's any number of things. It's been, government shutdown, government reopen, not normal reaction to any of it. And then we have November come along, right? And absolutely every possible thing that could have been thrown at the market in November, all in one sort of microcosm, happened in November as well. Mixed messaging by the Fed, throwing that out there that a December cut was not a surety after obviously all the big major players are in heavily interest rate sensitive positions because the market told us what they think of all this stuff, right? The minute we spiked down to 15% probability of an interest rate cut, right? Market sold off 1,000 points. You told me all along, and it was the funniest thing ever, Dan said the probability of there not being a cut in December was the same as me playing center for the New York Knicks in the 25-26 series and him being the quarterback for the, the San Francisco whoever's. But anyway, you were right at the end, and that I love that. But what we also went through is this madness, and I think it's worth addressing, is the fact that we had Palantir earnings, okay? Palantir ran up 7 days in advance of the November 3rd earnings. The earnings were epic, breakout, spectacular, and the stock sold off 8%, took the market down a little bit with it. And as opposed to the market interpreting this like, of course, there's a lot of uncertainty around November, December, government shutdown. The stocks had a huge run. It actually hit its record high on that announcement day, and of course people are going to be taking profits. There's nothing unusual about a stock running up 7 days. Buy the rumor, sell the news is the oldest Wall Street adage of all time. So, but to take that story and spin and weave this tale of deception, that actually is the earmark of the fact that AI is done. It's all smoke and mirrors. It's a bubble. This is a 1995-98 moment all over this story, to the point where people were scared to death that the same thing was going to happen to Nvidia and that this was going to cause a fracture and consumer confidence went down the tubes, right? All of this stuff happening over this one thing that's very common in Wall Street. When you have earnings, stock runs up into earnings, people sell the stock, profitability. That's where all their money was. It was a very complicated trade because crypto had margin calls, a lot of moving parts in this story. And then we have Nvidia earnings coming out. Sorry for all this pregame, but it's important for you to know where we're coming from. And then Nvidia is coming out with earnings. Everyone's going, oh my God, the whole same thing's going to happen. No, Nvidia sold off for 3 weeks into earnings, and it came out with epic, stellar earnings, even in data centers, and it ran up incredibly. So it's bizarre how we talk about it all the time. Mainstream media loves, look, you said it to me. There's no headline in them saying, oh, and Nvidia, Palantir earnings were great and the stock sold off. No, they needed to create a tale of woe. But the tale of woe scared the market to a point, right? It scared the retail investor. It scared the institutional investor. It caused the consumer confidence breakdown that we haven't seen since February, March, April. So all that being said, we're in the first 4 days of December. I'd love to have your take on it and just, you hold your ground. You're always in the, you're driving 70 miles an hour in the left lane. Anybody who gets in your way, you flash your lights at them and say, get out of the way, Dan's coming, right?
I mean, again, probably 90 to 100 miles an hour.
Okay, good.
Look, I mean, I would just say, look at tech earnings this week. Salesforce, MongoDB, Marvell, CrowdStrike. You're seeing the second, third derivatives are starting to play out. And I think that's the key. I think in terms of, the fears, whether it's Palantir, Nvidia, and you're seeing just the core growth. You cannot deny the demand. And I think at the end of the day, that continues to really be front and center. I think it's going to power this market. Like I said, that's how you wearing the S&P 7000 hat.
Yeah.
End of the year.
You got something to say about all this?
Look, S&P right now we're within 1% of an all-time high after everything the market had thrown at it in the month of November, and so many people saying, oh my God, this correction is coming in November. It's not coming in September and October. We're not going to have time enough to recover. the Russell is making an all-time high. That would not be happening if there was a serious possibility or concern out there about an economic slowdown. There is no way the small cap stocks would be doing this if there was a legitimate concern for a contraction in the economy. They'd be 30% off their highs.
So look, that means there's rotation going on, right? And so look, we're in a state. We've got 3 weeks left to the end of the year, right? You know, and I'm a firm believer that we could close out up at 50,000 the Dow and 7,000 the S&P. We're not here to predict markets, but it's just fascinating to know. Look, we've seen this movie before, but there's a different dynamic to it than we've ever seen. People need to understand that's why you are who you are, because you hold your ground no matter what the story is, right? They literally shook the trees enough, right? I mean, CNN called me last night. They said they couldn't reach you, but they wanted to talk about the story about the breakdown in consumer confidence around markets that happened during November. And maybe some of it was the government shutdown. Maybe some of it was the fact that we didn't have that economic. People were not getting the data that maybe gives them some comfort level, right? We didn't know that there were 1 million layoffs last year. We saw that from Challenger. We didn't know the ADP numbers that came out this morning, and then the readjustment of those, that there are a lot of people out of work. And then the other side of the coin is it turns out that it was the best report. It was the least amount of people demanding unemployment benefits in 3 years, right? So my question to you is, we know that bad news is good news, right? In the state we're in now, where economic data that shows a softer economy is good because it's good for the market, because that's going to pour fuel. That's more likely to cut interest rates if the economy's weak. That's how this whole game started, right? Bad news is good news. That's what happened yesterday. But this morning, good news became good news, right? Which I found fascinating, because a couple of tidbits of economic data that came out around jobless claims and around some other things made the market spike up as well. So, just give me a little tack on what you're thinking in the last 3 weeks of the year.
I just think we know what the Fed's going to cut next week.
Okay.
Bassett was going to come in. He was new Fed chairman. That gets announced next year. It's a dovish environment. And when it comes to tech, you're just starting to play out into these sort of next, second, third, fourth derivatives. It speaks to my view, like, you have a lot more to run in these names, especially I think as investors are underestimating, I think the scale and scope of this fourth industrial revolution.
We brought up one point, I asked him this as well, that there was a period of time where I was brought up again this morning, where you saw Meta and Google and Oracle and Microsoft all throwing hundreds of billions of dollars. It's not their wheelhouse, but into AI and into data centers, right? And there was a question whether by shareholders in one of the conference calls, why are you guys taking on debt to support this AI story when it's not our wheelhouse? And we talked about it, that these people who run these companies are visionaries. If in 5 years AI and the tech sector is trading 10x to where it is now, and they did not put that money to work in AI, the shareholders would be screaming at them going, why didn't you? And now they're thinking, you know what I'm saying? There's a certain, it's like either it's immediate gratification or it's sort of a short view. They're not realizing that these people are running these companies for a reason, because they are visionaries. You got something on that?
Not directly on that. I agree with what you're saying, but I want to go back to this economic data and this very, very weak consumer confidence report. And there's something wrong in that report, because if you want the most current piece of data on the consumer, look at the spend on Black Friday and Cyber Monday, and it certainly is not consistent at all with a near record low level of consumer confidence. Now, I know there's some people talking about at the high end, very, very high end, consumers are trading down and shopping for value a little bit more. Well, why shouldn't they? But look at this record spend on Black Friday and on Cyber Monday, and it is diametrically in the opposite direction from what we've seen in the most recent consumer confidence reports?
Well, you know what I will say to that is, even people, look, we know that the market is the market and the economy is the economy, and sometimes they don't fly in the same ocean, right? And that people who are living paycheck to paycheck and who may be struggling are not people who are investing in the market. We know that. But at the end of the day, think about it. Even people who are struggling financially are still buying their kids Christmas presents.
Yeah.
They're still spending money. That's the funny thing about the psychology behind about e-commerce and about spending and this social media world we live in, that people are being impaled with so much impetus to buy stuff. Look, it's my old adage, buy stocks, not stuff. Right? I mean, you know, but people do still love to buy stuff. Stuff is the definition of success in a way. Go ahead.
And Peter, I'm going to go because I have to speak at this thing, but I just want to say one thing to Tim. Like, to me, it's just, I think, as you start to think about the setup, not just in the year end, but next year, I actually think it's one where, I think it's one where you can see in the beginning of the year, tech actually flies a lot higher. I think a lot of these names have gotten way sold off relative to expectations.
You've certainly had tremendous consolidation.
Those stories are starting to play out.
Yeah, you've certainly had consolidation in a lot of those tech stocks to where, you know, there's going to be a lot less resistance on the way up from supply, from sellers, if they do start to move back toward their old highs. I mean, I realize the indexes are very close to their old highs, but I'm talking about names like, and I have to be careful about how I talk about individual stocks. I'm not a registered analyst like you are, but names like Oracle and names that are down, you know, 30-ish% from their all-time highs. If they start,
that was like 3 weeks ago. They
Right.
were that drop was fast and furious, and that happened because of the thing I described.
A little bit of a period
or maybe
of time.
6 weeks, but it was sort of short.
And also, I think also it's like, I mean, Tuchman going from the yellow scarf to black. You know, is that bearish?
There are no bears in my place. You know that. I'm going with the yellow scarf. I'm running like Forrest Gump. Run, Forrest, run. They're going to have to put up a sign to say stop when they're done.
Yeah. See you guys. Remember,
Danny,
stay bullish.
call me soon. I'll talk to you later. It's so nice to have you. Thanks, buddy. To the moon. Let's keep talking.
Okay.
So you're the best. So let's talk
touch on one other topic
Okay, let's do it.
before we forget about it, and because I think it is a little bit meaningful. There was some concern about the ADP jobs report.
Right.
It came in a
Let's go.
loss
Let's give those numbers. What was
of
it?
32,000.
Okay.
The first time we've seen a loss of that magnitude, and it's not even a high number.
It's 32,000. There was a loss of 32,000 jobs.
Yes.
Okay.
Private jobs.
Right.
Now,
and we thought it was going to be 10.
my interpretation of that is that you look, you're always going to have some attrition of people just, you know, retiring, leaving their jobs, whatever. Maybe there's reviews that go on at the end of the year. A lot of companies maybe cut out the bottom 3%,
right,
et cetera, et cetera. But I think that number, I think the shortfall in that number comes from a lack of hiring, not necessarily a lot of firing.
Gotcha.
Attrition is not necessarily firing.
Right. It's not negative. It's not a negative indicator.
Now, we did have this one headline a few weeks ago that Verizon was going to cut back 15,000 people. Okay, look, Verizon spent trillions of dollars the last 5 to 6 years building out 5G.
Right.
It's built out.
Right.
They have completed that massive CapEx spending program. They might have hired 45,000 people when they began that. I don't know what the number was. I know it was more than 15. And now they're trimming back on 15,000 people because this massive multi-trillion-dollar CapEx spending program to build out 5G is complete.
Right.
So that's not our business is falling off a cliff type.
I agree. Look,
job cut. That's just we expanded significantly.
You will often say that they're going to have to grow their way into those numbers, right? We talk about that all the time.
So now their leverage is a little bit better.
Right.
They've got 15,000 fewer employees.
Right.
I'm sure though, and you don't have, but you don't have a lot of firing or cutting back announcements in 2 or 3 companies
Absolutely
in
not.
every industry. This is attrition, but companies may feel like where you don't have the cutbacks, they're not necessarily doing a tremendous amount of hiring right now. They might feel that they're full, and they want to see. They want a quarter to go by and see, does this AI really mean we need fewer employees, or do we just need to
That's a good point.
reposition
I like that.
some
So
employees?
maybe
So I'm not terribly concerned. Look, I'd love to see it plus 200,000.
Right.
But I'm not terribly concerned with the number the way it came in.
But you know what? You are touching on a point, which is a lot of people's fears, is that the more
Absolutely.
AI takes over our lives and the more money is being spent on it, people still don't believe that it is not going to outsource human beings.
Yep.
And that fear, whether you're a college kid going out into the workforce for the first time, or you're someone who's switching jobs, or you're someone, look, when I thought that was why I stayed away from AI. I thought AI was going to just be a terrible thing for everything. And Dan has told me, obviously, no, not at all. And if you're wondering what to do as a college student, you go out there and learn all the things necessary within the AI space. That way you'll be guaranteed, but they're not going to outsource us. It's going to be a way better life. But you're talking, one of the numbers that came out, so the market sold off and then spiked this morning on news that the number was, they were looking at 191,000. It came in less than expected, the revision. But then, so the market spiked up, but then one of the little tidbits that came out was that people are staying in their jobs longer than they have in the past. Wasn't that a little bit of the headline?
But now that's not necessarily a positive thing for the long-term job market, because when you see people leaving their jobs at a quicker rate, that means they feel that they're going to get a better job easily, or they're going to get a similar job with no problem at all. So if they're staying in their jobs for a longer period of time, if you have fewer people leaving their jobs of their own volition, that could be interpreted as a little bit of a yellow flag for the job market. But I think the job market is going to work through this fear of AI making significant
negative effect
into the job market.
Okay, you know what? It's 2:00. I got to rock and roll. That's enough out of us. We got a little bit of Dan. We got a whole bunch of Tim. We're talking about the year end here. We're trying to understand what happened in November and where we are now in a little bit of December. It's all about interest rate cuts next week. It's all about the next few days as we unfold the data about the fact that, you know what, the consumer actually is in better shape than they're trying to tell us, because people are spending. This is 75% of profitability of retail happens in these 2 days. Now, did everybody save up all year? Maybe. I could present any number of scenarios to you that people made a whole bunch of money because they bought Palantir at 30 and sold it at 180, and now they're spending money even if they have nothing to do with the stock market. When you know that something's up, when the guy selling hot dogs on the street, the guy driving the Uber, and the hedge fund manager all talk about go to an Nvidia earnings release party. Anyway, it's fascinating how Wall Street is permeated everybody's lives. That's why we're here. That's why we love what we do. And so what? This is a day at a time story, and we're going to be coming out. I love you. Trade like Einstein. You got to be in it to win it. Check it out, Einstein and Ives. We brought my man Tim in for the ride. That's all I got to say about that. Boom.